Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from chartsandmarkets.com tells us about the Nasdaq and the S&P 500 hitting or nearly reaching record highs. He also discusses the expected cycle we'll see with a U.S. election about a year away. Josef Schachter from the SchachterEnergyReport.ca drills deep into what he sees in oil and gas and what the fleeing of energy giant Encana to the U.S. means to the Canadian energy sector. Ed Steer, founder of EdSteerGoldandSilver.com, tells us what's happening in the precious metals sector. And at the end of the show, we'll have a company showcase update from American Manganese President Larry Reaugh. We'll talk to Ross Clark right after this.
AMY.V Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, AMY.V's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at AMYresources.com.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. And Ross, right off the top, you're continuing your holiday special?
The special, well, hey, it's a Thanksgiving and Christmas all together as far as the Americans are concerned. We are offering the service for $60 through the end of the year. You can contact us at the website, chartsandmarkets.com, and right there on the front page there's a link to the subscription.
Ross, we've seen near record highs again in a couple of the markets. What's that telling us?
Well, in most markets, we take a look, the Nasdaq in particular being led up there by the semiconductors right now, doing very well. The S&P managing to make new highs a week ago, with a pause this week and then back again up on Friday after, good employment numbers, sparked the market, rise here. We had been looking at the potential of a rolling top. The key was going to be that coming out of the lows, that corrective low that we had in September, as long as the momentum didn't roll over, then the bias was still up with a potential of rolling over. But with the Dow finally managing to take out the September highs, although it isn't an all-time high, taking out the September highs in November is very, very important. Historically, November is the best month of the year, and that's usually because it's coming out of a bad September, October. But when we take a look back at years in which the market did break out in November, it has an exceptionally good track record, and we're talking about 100 years worth here, of then pushing through and having good momentum for the next 3 to 7 or 8 weeks. And when we look in particular at pre-election years such as this one, and then we look at the decennial pattern, so that would be every year ending in a 9, leading up to the decennial year next year, the potential for a year-end high, the turn of the year trade that we generally look at, strength right in particular in that latter part of December into early January. The probabilities of a high up in there look pretty good right now. And in most of those scenarios, the correction into February can be pretty hard. So upside bias at this point, and probably looking at, a Dow that could be as much as maybe 1,000 points above where it is right now. But, don't get married to the trade. The idea being that once it starts to roll over, maybe in a month or two, you're going to want to lock in as much as you possibly can.
A year from now, we'll have the latest round of U.S. elections. Do we see a market pattern going into the U.S. election phase?
Well, yeah, you typically are going to have a low in February and then another low in what normally is the seasonally strong period out in the May area around May. But from there, you're looking at strength as you push through into the second half of the year. So next year could be a bit of an anomalous pattern from what people are used to. Instead of looking for the best 6 months of the year being November through the end of April, you tend to get a real hiccup as you move through next year. So I think the point being that if you're going to be aggressive on the long side next year, you're probably looking to do that out in maybe the end of the second quarter of the year. That's probably going to be the best window in which to do it. And, by then we'll probably have a better idea of how the Democratic Party here comes up with a nominee, and just the strength of the base as far as Trump is concerned.
Ross, thank you so much for chatting with us.
Always good to be with you, Jim.
My guest has been Ross Clark from chartsandmarkets.com. Coming up, we'll drill into oil and gas with Josef Schachter next on This Week in Money.
Always consult your investment professional before making any investment decision.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlan, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the 2019 drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. We're speaking with Josef Schachter, founder of the Schachter Energy Report.ca. Josef, welcome back to This Week in Money.
My pleasure. Good to be with you, Jim.
Josef, you just wrapped up a conference in Calgary. Can you tell us about it?
Yeah, we had a conference in Calgary. It was an energy and energy service conference. That's the second year that we've run it. And we had, 450 people or so at the conference. There were about 24 companies presenting. And we had, full rooms for all the large companies, especially Tourmaline, Vermilion, some of the largest companies in Canada. And then we had, companies both in the energy and energy service side. So we had a nice mix, and we went all the way from multi-billion-dollar companies down to companies, trading in 20, 30 million kind of market caps. We also had, at the end of the day, a panel with three of the Indigenous leaders from Western Canada, who were there to, answer and be part of a panel of the issues, the ownership of TMX, how working relationships work with the indigenous groups, how to make them work successfully for everybody. So it was a very, very good program. And we've already signed up for Mount Royal University for the 2020 conference. So it was a great success, and most of the people that I talked to, or all the people that I talked to, were enthusiastic about it and thought it was a great improvement over the prior year. So we're now sending out a survey to all the attendees to get their input to try to make it even better next year.
Now, there's an impression out there that First Nations people are against pipelines and natural resource development. What was your take from having heard from these three Indigenous leaders?
Well, the Indigenous leaders, have a lot of problems on their land. Number one, water issues, clean water. Two, jobs, so that they can keep the young people at home and keep them, away from less attractive avenues than work, without going further on that. And a lot of them economically not only need the jobs, they need the revenue. So, to them, working with the oil and gas industry out in, the rural parts of the province in Alberta and Saskatchewan, and having jobs that are well paying, so that the individuals working can take care of their families and provide well for them. So they're very, very supportive, especially in Alberta, where they've worked with the industry for many, many decades. And in the part of, eastern BC, where the oil and gas industry is, they again are very, very supportive. What you're hearing, the ones that aren't supportive, are the ones that are not on the rights of way, or ones where they are concerned about some of the environmental issues on the coast or river issues. And right now they're not getting any benefits from the agreements that are in place. So they're looking at their neighbor doing very well and them not, and saying, why not me too? So, there's a lot of issues that have to be resolved. The federal government is working on that, and part of it will be ownership of the TMX line by indigenous groups that want to own it and pay for it and be major environmental stewards. And then there are some other groups that will get, some small ownership for them to be, again, part of the stewardship and to vote in favor and be supportive. And again, there's tens of thousands of jobs I think are going to be created when LNG projects on the coast go forward. And of course, the TMX line itself will create quite a few jobs. So there are both short-term construction jobs and long-term very good jobs in this sector. And also the drilling industry will have to be much more active, finding and bringing on more natural gas for it to go in the pipelines to the LNG facilities on the coast. So there's lots of upside for everybody, and provinces benefit with royalty revenue. There's lots of new jobs, high-paying jobs, and of course, there's so much industrial equipment used that the benefit even goes into Ontario and Quebec, where a lot of that machinery is built.
Now, Calgary has just seen Encana Energy decide that it's going to pull up stakes and move to the U.S. How big is this story?
Well, it's very disconcerting that, this was a Canadian company that was spun out of CP. The history of it was a massive Canadian energy company, at one point probably one of the largest. They sold off a lot of their assets when they got into financial duress. They went to the United States and built up a bigger presence in the shale plays in the States. And the CEO moved to Denver. There's a big operating office in Denver and also in Houston. So the question is, where is going to be the new head office? But they said it in the conference or in the presentation on Monday that there wouldn't be a lot of job losses. But a lot of people in Calgary are very skeptical, because if you're going from Canadian securities law and accounting law to U.S. securities law and U.S. accounting, regulations, then you sure don't need a lot of people in Calgary doing that. You want them to be trained on the legals and the accounting rules down south. So I think that it's like what we saw with Nexon and CNOC. They say that they're going to keep the jobs, and then of course as the evidence comes out later and as the needs change, that changes. So this is a big disappointment. And the basics for them doing it is they had more of their assets in the States than Canada, I believe 60-40 in the States after their major acquisition last year. And then the other part of it is they want access to capital and also to the index funds that invest in energy, and they're not going to Canada. If you're listed in the States, you do get more exposure. So they're doing it for long-term interests of their U.S. shareholders, and it's too bad that the history of Canada, we're losing another company. Every time we have companies that are successful, either they get taken over or they get too big for their britches, like Nortel or BlackBerry, or you mentioned other names in the past, and it's just too bad. It's Dome Petroleum on the oil side. If you go back to the 1970s, 80s.
Is this a sign that the government has a lack of an energy policy, and people in the energy business are just nervous about that? They don't know what the direction is?
Well, the thing is, from a company's point of view, they're going to go where they can make money for their shareholders. And if the netbacks in the United States and the regulatory environment is more supportive, the egress issues are not problematic, you're going to go where you can go to make money. And a lot of the drilling companies have moved a large amount of their best assets to the United States, because that's where they can keep their people working, and they can work 12 months of the year, versus in Canada with breakup of 3-4 months you can't be working. So the benefit to both the energy and energy service companies has been to go to the United States, and those U.S. assets have done better than most Canadian assets. And again, the egress issues, the politics in Canada, the anti-energy views of our Prime Minister, the problems with Quebec with pipelines, BC with their issue against oil pipelines and tankers on the coast. There's just one problem after another. And if you are facing those kinds of headwinds and you have opportunities down south without those headwinds, it's a natural for that to happen.
Are we at an important time for the price of oil?
Yeah, I think we're getting near the seasonal lows. Right now we're about $55-56 right now. And, usually prior to winter, so again, right now we feel winter in Calgary, but we're talking about winter throughout the United States, when prices, really take off in the cold weather. My view is that right now, between now and, late December, there's a chance for prices to go down below $50. I don't think they're going down much below that, 47, 48 at the worst case, versus the 42 that we saw in December. If you remember, December 23rd of last year was the tax loss selling day low for the energy sector, and also the $42 price that we saw on that day for crude oil. So historically, between now and mid to late December is when we see the lows, and then from there you can see a quite strong recovery. From my point of view, this is a very bullish opportunity that's coming, because we've now had 5 years of underinvestment in the sector. So 2015, 2016, 2017, 2018, and now 2019. And we're now seeing in the Q3 results that are coming out, many companies are spending less than needed to keep production up, and they're using the excess cash flow to pay down debt. And again, debt is a problem for a large number of companies in the sector, and the lines of credit are being pulled, and if you can't service the debt, you're finding yourself in duress. And for example, Pengrowth today, we just saw that the company is being taken over by a private equity, and the fixed income or the debt lenders will be taken care of, but the common shareholders are going to get a nickel a share. The stock yesterday was 20 cents, and before it was halted, and it's down to 5 cents today. So it's down 75%. So it's a massive take under, but there is some residual. It's not a zero for shareholders. There's also a stub if there's a win on a lawsuit. But the bottom line is, anyone with debt that has servicing problems or creditor relationship problems or creditor lack of support problems, there's going to be companies that probably will fall by the wayside. And we've seen a couple already this year. And it's, if we see more problems in Canada from our regulatory side, and there is not some decision to support the energy sector to a cleaner industry, and also to, especially natural gas, and also to having the ability to grow, i.e. egress and LNG on the West Coast, then, we may see even more companies after year-end, face difficulty and, pretty problematic for the industry. It's a lot of people feel like the guillotine is out there, and are they going to get dragged up?
Are there indicators that tell us where we are in the oil cycle?
Yeah, we're in the in a period, as I said, of underinvestment. So that sets up, the solution for low prices is low prices, because your investment goes down, and as you have less investment and a shorter reserve life index, it sets up the next bullish cycle. And I think we're in that situation. I think we're also in a major commodity cycle going forward, because you look at the lack of spending in base metals, precious metals, uranium, you name it, and energy. This year, starting from late 2018 through most of this year, gold and precious metals have taken off. So they're the leader in the commodity cycle this time. My bet is that in 2020 we're going to see oil join the party, and I think we'll be looking at $70 WTI in the second half of 2020, and much higher 80, 90s in the outlier years thereafter, as the industry needs to start spending more money to bring on more capacity, because we aren't going to go off energy and especially natural gas, but we still need oil. We're still going to be having cars on the road, even though EVs will become a bigger and bigger portion of the total fleet, but they're still going to be needed for planes, for long distance travel, where individuals and industry are going to need to have oil. And also, we use oil in so many products that we use. that either oil will begin to consumed in transportation or industrial products or or in petroleum products. So we need to see more production come on. The BP did an interesting study, which you can go to the website, that by 2040, if we didn't see EVs become 30 to 50% of the new cars on the road, we're going to need 130 to 140 million barrels a day of productive capacity. Right now we have about 100. But if we see that kind of, then if we don't have that, we'll see 130, 140. If we do see higher EVs and more fuel efficiency, we're still going to need about 110 million barrels. And again, we only have 100. So we've got to replace the declines, which are 8 or 9 million barrels a year, and we're not doing that right now. Plus, we need to bring on an extra 10 million barrels a year over the next 2-3 decades if we're going to have enough oil at reasonable prices. And maybe price becomes the factor that allows, the equilibrium.
Is oil likely to be replaced by alternative energy sources in the long term?
We're going to need the alternative energy sources just to meet demand. We all want a higher standard of living, and you look at what's going on in Asia and South America and Africa. The 1970 cycle was driven by strong economic growth in Japan. The 2008 cycle was driven by China going from a kind of a closed economy to a market economy, and the price of oil was driven by their economic growth. And then I think the next phase of this is going to be India. They want to move significant amounts, hundreds of millions of people from rural India to urban India to go into manufacturing, industry, services sectors. But that's going to require more efficiency of moving the rural food production into the cities without a lot of waste, which is occurring now, which means you need 4cc small trucks for the local farmers to be able to get the full value of their efforts and produce. And again, that is on the way, and that is happening, and that's why you have a lot of car manufacturers in India and building small fuel-efficient vehicles, and that I think is the basis for a long-term, very bullish cycle. But we're going to need renewables. We're going to need more wind. We're going to need more, solar. All of that is going to be needed just because of economic growth, population growth, and the fact that people in countries of lower economic standards want to have higher economic standards and benefits of the quality of life like we do.
Is geopolitics playing a role in the oil market cycle?
Every day. The Saudi Arabia issue after the attack on their major infrastructure facility up top. Iran, of course, is not being able to produce, so they're becoming more militant and, there's been a number of attacks that people are concerned about. And so to me, this is something that is going to probably be more of an issue in the outlier years. Venezuela, of course, is imploding as a nation. There's so many hot spots around the world. And again, if that removes any production of oil, that is a lift for the price of oil. The longer and the higher the price of oil, the longer the disruption persists.
We'll have more with Josef Schachter right after the break.
Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. We're speaking with Josef Schachter. Josef, is global investment in oil increasing?
No, we're seeing, maybe in certain areas, in the Norwegian area, offshore, they're finding more. There's going to be more spending in the salt areas of offshore Brazil. Guyana, which is where Exxon and Amerada have had some major discoveries. We'll see more. But in Canada, there's been reports coming out of less spending in 2020 versus 2019. The rig count came out today by Baker Hughes, and it fell another 5 rigs to 142, and that's down 28% from last year's level of 198, and 198 was not real good. We're used to 400 or 500 rigs working in the good days. So the problem are persisting, and a big part of it is the debt loads and these low commodity prices and the fact that creditors are making it more difficult and they want to get paid back. And so they're saying, instead of you growing your business, you're there to generate cash flow to not only service the debt you owe, but also to pay it back. And we want to pay back because we're concerned about all these political issues in Canada, the egress issues, and we want you focusing on debt repayment, not on anything else. And that is part of the pressure point that we're seeing out there now.
We're hearing rumblings of a global recession. Would a global recession affect the supply and price of oil?
Yes, on the demand side, of course, you'll have less demand, which would mean that if production stays the same in OPEC, that there might be a glut. But on the other side of it is there'll be less cash flow because of lower prices, so that the industry will not be able to replace its production, and that'll set up the stage for a bull cycle longer term. Because if you have less production and then we start going into a stronger demand period. Now, normally these corrective periods last between 6 and 9 months. If you go back to 2008, the peak was in June at 147, and we bottomed in, I think it was $34. I think we bottomed in March of 2009. In 2015, 2016, we came down to $26 in February. Again, there was a 6 to 9 month situation. So we've really had oil peaking in the 70s a year ago. We rallied into the 60s when there was the attack on Saudi facilities. But we're now into the period of softness like we saw last year in the last 6 months of the year, particularly the last November-December period of 2018. And that's what I think will happen now, and that's going to set the stage for investors to take advantage of the disruption and low prices, because tax loss selling gets very nasty during that period. And people are saying, look, I booked a massive gain in something, whatever it is, in another area, be it a FANG stock or whatever, and instead of putting it into income and paying your marginal tax rate on half the gain, if you have a loss on your books, usually your investment advisor will say, look, this stock is down, and if you want to buy something in kind, go right ahead, but if you have a loss, take the loss. And most of the energy sector, both the energy and energy service sector stocks, are down from where they were a year ago, which makes them makes them very likely tax loss selling candidates.
Is the cost of oil production rising?
The industry has been very good at trying to cut their costs as much as possible, becoming as efficient as possible. But a lot of the input costs, like labor and natural gas, are very cheap right now. If we see a recovery, then, of course, natural gas will improve. And, of course, there's a shortage of manpower if you want to, bring on more rigs or more frac units. And so you're going to have to raise the labor rates, and then you're going to have to bring on new people and train them, which would be a cost increase. So the industry probably is at the lowest level, in my opinion, for its cost structure. And that if we do see a recovery, the costs will go up. But the question mark is, will the price of the commodity go up much faster, which will allow margins to be better and for companies to be able to afford the incremental costs? And that's what's happened in the past cycles, that the price of the commodity has risen faster, plus the volume growth when companies can spend the money, and then the totality of higher prices and higher volumes give you extra cash flow so you can afford the cost increases that are naturally going to occur in a recovery phase of any industry.
What's happening in the natural gas market?
Natural gas has really taken off. We're just on the verge of $3 per acre, which is a fabulous price. And again, the cold weather, it's the old story, like in real estate, location, and in the energy area, it's weather, and we're getting cold weather. The other part of it is the TC decision, where TransCanada has now changed the way they have access to the pipelines, so that companies can now get access for storage. And then, of course, I think that the storage levels in Western Canada are very low right now because of the issues of access to them. So if you get any cold weather, that really pops the price. And we've gone from under $1, 2-3 months ago, and we're on the verge of $3. And I think during the week we were over $3 for some of the days. And again, these are very, very good prices because most companies have break-evens much less than $2. And so if we can get $4 and $5 during the winter period, this is Christmas for the oil and gas industry, and that's when we'll see companies do well on a cash flow basis and have the money to pay down some debt. The problem will occur is after winter is over in the spring, what are natural gas prices particularly going to be? Do they go back down to 20, 30 cents where nobody makes any money? Or because of the TC decision and potentially quotas on AECO dry natural gas, just like we have the quotas on oil, I expect that there's going to be pressure to put on some kind of a apportionment situation for natural gas until we have the demand growth within the province and the LNG growth come on stream, and then you won't have to do it. It's like what's going on now with the oil quotas, where the province has said, if you bring on more rail capacity, we will allow you to bring on that capacity, and the quotas come off on that capacity. So the industry and the government are responding for a number of reasons. One, there is egress there's lots of, of course, the rail cars the government got, and then there's, the price that the spread between WCS and WTI covers the total cost of rail now, which is a positive. And then the industry is responding. So we're hearing now from companies that are announcing that they're planning to increase their rail takeaway. So potentially in Canada, we could see a 10% increase over the next year in takeaway capacity between rail and between the tweaking that's going on pipeline systems to move more product through. All of that is positive from the volume side. The real more important thing is we need much higher prices for the industry to be justifying spending money to bring on more capacity, and that's where I think the change will occur. I think the first half of the year we may be between 50 and 60 in 2020, but I think in the second half of 2020 we're going to be looking at north of $70 WTI, and that will be why stock prices will be much higher at the end of 2020 than they are now. And where they may be, a month or so from now, I think there's a chance for a 10-15% decline in the energy index between now and, the end of tax law selling season. But we're recommending to investors to take advantage of that, depressed conditions that are coming up, and that, if they take a long-term 3 to 5 year time horizon, there should be some very, very attractive total returns.
Is there a positive case for oil and gas going forward?
Yeah, we're not stopping to use it. You and I are still driving our cars. I'm heading up to Edmonton, on the weekend, to visit family. We're all still flying. What I find very amusing is that the environmentalists who are saying, stop. Well, ask them specifically what they're doing. Does Suzuki still fly in private planes? Does Al Gore still have monstrous houses that are energy, fiends? To me, we need to do something because, of course, this issue is serious, and we do want to, lower carbon emissions. The industry is spending a lot of money and focus to do it. They're not the bad guys, they're not the black hats, if you're looking at, the cowboy game. The companies are really working hard to be, good corporate citizens, and they're not getting the credit. Everybody just says it's bad. Well, if it's bad, then, people have to change their habits. Do you have a big house in Vancouver and you use a lot of electricity? Well, or do you go and, fill up your tank and you have a big cart because you're going off to Whistler to ski? Come on. You can't expect the energy industry to be the bad guy when the consumer, is the one that has to change their habits as well. It's like if people look at the drug industry, is it the cartels are bad, or is it the thing that we have to get people off of, using and consuming, those products?
Is there also a negative case for oil and natural gas going forward?
I think you can argue more for the negative case that, for oil, because again, as we move to EVs and as we move to, cleaner and, environmental, usage, But natural gas is really, if there's not enough solar or wind or tidal or whatever you want to talk about to meet the electricity grid needs as the economy grows and as populations grow. You're going to have to still need a fuel, and if you're not prepared to go to nuclear power, then natural gas is the big winner longer term over the next decade, 2 decades, 3 decades, until maybe we find antimatter or something, go to the Star Trek or Star Wars, fusion power or whatever. So we're going to still need fossil fuels in the decades to come. The question is, can we get the best, most environmentally friendly of those until we come to transitions that give us the next phase of growth versus coal, being, and it's clear that coal is the one that has to go because of its environmental footprint. And we saw this week one of the largest coal companies in the States go bankrupt because demand is not there. And again, that's the whole thing of moving to the most carbon efficient and lowest cost way of producing electricity for the grid.
Could we see the price of oil exceed the highs of 2008?
If we have, decent economic growth in the next 5 or 10 years, we're going to get over 100. To get us over the 147, you'd need to have some disruption in a major supplier, and that would require something to happen in the OPEC world. So if there was any way that you disrupted Kuwait's production or Nigeria's, or more importantly, if it was Saudi Arabia was out for any length of time, you would see a spike up. So that, to me, is the wild card for record oil prices, would be some disruption of supply of a major producer in the Middle East, part of OPEC.
Is the power of OPEC diminishing?
You look at it right now when you have a bit of an oversupply, and the people will say, yes, it's diminishing. But if we get into, stronger economic conditions, the shale plays in North America, which has saved the day in the last few years, has a very high decline rate. So if we get strong economic growth, and we're going to need OPEC to increase production. And so OPEC, in strong economic times, when the non-OPEC world does not have the ability to increase supply, the swing producer becomes OPEC, and the major swing producer becomes Saudi Arabia, which is the largest producer in OPEC. So in that case, you could argue that OPEC's power would increase. Right now, when you have soft conditions and too much supply, your argument, the comment about OPEC's power diminishing is correct.
How important are pipelines to Canada's oil and gas industry?
It's the lifeblood. It's the air they breathe. If you don't have pipelines, number one, you move stuff by rail if it's oil, but you can't move natural gas that way. So the key thing is we need pipelines. It's the most efficient because you look at it, you're taking, crude oil from, let's say, Fort Mac, putting in rail cars, moving it down to the Gulf Coast full, and then, you bring back those cars empty. That's a very inefficient use of rail cars. And then you fill them up again and go back and forth. So, and the cost is, maybe $17 to $19 per barrel of movement cost. If you go through, pipelines, your cost could be, depending upon the distance, between $6 and $9. So it's half the cost, a third of the cost, depending upon where you're moving it. So to me, pipelines are very efficient. They have a very, very good history of being, reliable. What people have to know about the ones where we're seeing problems with now, most of them were built 40 or 50 years ago, and they've passed their official normal planned life. And so those pipelines have to be replaced, and that's part of what we're trying to see happen, is approvals to reline or replace pipelines that were built, many decades ago that fulfilled successfully what they were intended for. And now, of course, you need to, like it's like you and I have a car, once it's 20, 30 years old, we have to at some point replace it. Fuel efficiency wise, in terms of acceleration, just the repair in parts, for an old car. The same thing is with pipelines. You've got to be spending money at some point to refurbish them or expand them or add more compression, and that all requires investment. And so I think pipelines are very important. It's made, Canada one of the biggest producers in the world. We produce over 5 million, I think 5.4 million barrels a day. We export to the States around 3.4, which is our biggest customer. And what we need is egress and more pipelines so we can ship more to Europe and Asia. And that's going to be the battle that goes forward in terms of the issue of egress over the next few years. And so far we have the Prime Minister and the Liberals in favor of TMX, which is oil, but we're also going to need much more support for other oil lines, and we're going to need more natural gas pipelines, both to go to the States, but more importantly to the West Coast for LNG, and also there's potential LNG on the East Coast as well.
Would, at least in theory, a completed Trans Mountain pipeline mean lower gasoline prices for Greater Vancouver?
Again, it's the issue of how much of the component is tax. I think the margins for the refineries on the coast are very high because of the shortage issue, so they can have, it's like anything, if you have something that people want and you have a monopoly or very close to a monopoly, then the price is higher. So I think that's part of the reason that you're seeing higher prices, but more importantly, it's the higher taxes, higher land costs, and so the price has to be higher in BC. I think you guys are in the 150s per liter. We're sitting in the 90 cent per liter. Again, economic conditions are weak in Alberta. There's an excess of supply here, and the reverse is the situation on the coast in BC.
Are people who follow the Schachter Energy Report more likely to invest in the oil and gas commodities, ETFs, or stocks?
I think that, as they get comfortable, with, our view of the macro long-term situation, right now we're telling people to hold their cash and wait for the great buying opportunity that we expect to occur during tax law selling season. The only stocks that we're saying to people nibble away on if you see very cheap is the high dividend yielding energy stocks, and many of them are yielding high single digits. Some are even double digits, and the companies keep on reiterating that those dividends are payable at these commodity prices, and they continue to support paying those dividends. So the industry is so out of favor that people are running away looking for yield everywhere and buying junk bonds and whatever, and yet you've got an industry in Canada that has sustainable dividends that are in the 8, 9, 10% level for some, and there's quite a few that are in the 5% level, which are much higher, of course, than the dividends you can get on banks, and you can get, and that's or any other areas in the equity markets, and they're doing it when we have trough commodity prices. So, to me, in the years ahead, as commodity prices pick up, and companies that need to repair their balance sheets do that, they will be able to use the excess cash flow for both dividend increases and normal course issuer bids, which is a lot what Bay Street wants right now. So to me, the timing of investing in energy is to take advantage of the tax loss selling which occurs from late November through late December, and that's what we're advising. So, if anyone's interested, they just go to www.schachterenergyreport.ca, and they can go to the website. There's some free publications there, and they can also look at becoming either annual or quarterly subscribers. And if we're right about the energy cycle kicking in here, it's going to be a very attractive way to invest, and there's not many independent sources for energy out there, and that's why we created the product to meet a need that we felt was going to occur, and the business we've built so far has been excellent. The conference has gone very well, where we put people in front of the companies and of course companies in front of individual investors. They do lots of road shows on the institutional side, but there are very few access points for individual investors, and that's where we've created a product and also an access point for both the individual investor and the companies to go face to face, and for both to know each other, and the bottom line is investors can hopefully find names that they're interested in and buy them and hold them and take a long-term investment approach for hopefully significant total returns.
And Joseph, for anybody who's seen you on Bloomberg television, you have one of the most marvelous, I call it bow tie portfolios I've seen.
Well, there's probably a few hundred of them, so the question is, when I pull out a suit for saying I'm going on a road trip, I usually pull out 3 or 4 that will match, and then it depends upon the mood in the day. Do I want something more brighter or more subdued? That's how I approach it, but it's fun and it's a different look, and since the early 1990s, it's been one of my personas is he's the bow tie guy.
Mm-hmm. Joseph, thank you so much for being on This Week in Money.
My pleasure. Very, very. Have a good one and have a great weekend.
My guest has been Josef Schachter, founder of the Schachter Energy Report, online at schachterenergyreport.ca. He was speaking to us from Calgary. Coming up, Ed Steer, next on This Week in Money.
Cypress Development Corp. is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp. trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. We're speaking with Ed Steer, founder of edsteergoldandsilver.com. He's also a director of GATA, the Gold and Silver Antitrust Action Committee. He's speaking to us from Merritt, British Columbia. Welcome back to the show, Ed.
Yeah, good morning, Jim, to you and to all your listeners.
Ed, do gold and silver look like they're stuck in a new trading range?
Well, they certainly have been for about the last 2 months now, not varying much either up or down. We had a blip up yesterday, and now we're down again today, so we're going to stay in this trading range until the powers that be decide that they're going to move the market up or down. We just don't know which it's going to be, but right now it's a real snoozer of a market.
With the Fed dropping interest rates this week, are we likely to see a weaker U.S. dollar and stronger gold and silver?
Well, we certainly had an initial reaction Wednesday or Thursday when they did drop the rates. Gold and silver were up a bit, and the dollar was down a bit. But if there's going to be a reaction in the dollar, like a big reaction, we would have seen it by now. I looked at the 5-year trend for the U.S. dollar index, and it's been very steadily and unevenly higher for about the last 18 months now. And if there's going to be a break in the dollar, we would have seen it by now. But when the break does come, regardless of what the reason, it will be very noticeable because it will drop by quite a bit. But right now, it's gradually and quietly upwards, regardless of what they're doing with the interest rates in the U.S.
Has the value of the U.S. dollar and the value of gold kept their traditional, if one's up, the other one's down, lately?
Oh, not at all. There's been lots of days where the gold and silver have been rising along with the U.S. dollar. There's no question about it that the usual comparison between the U.S. dollar, if one is going up, the other one is going down, is sort of gone by the wayside. Of course, there are days when that does happen, but if you look at the longer-term trend going back to about 6, 8, 10, late last year, there's no question about it that gold and silver have certainly broken free of the U.S. dollar.
For a person who doesn't have a lot of money, and if they're bullish on gold or silver, what should they put their cash into?
Well, if you don't have a lot of money, my advice is buy silver. It's cheaper than gold for a start. You get more for your money. And there's no question that when these gold and silver rallies are finally allowed to occur and the prices are allowed to trade more freely than they are today, silver will vastly outperform gold, and I can't overemphasize that enough.
What are the latest commitment of traders numbers for gold and silver?
Well, last week they were up a bit. The commercial net short positions were up a bit last week in both silver and gold. Silver analyst Ted Butler, whose work I follow very closely, figures are going to be up again today. I know this show is being broadcast on Saturday, but he's expecting more increases in the commercial net short positions in both gold and silver, which is not not positive for the price. And of course, after yesterday, that'll be on next week's report. But basically what you see right now is the commercial traders, the big 8 traders, J.P. Morgan et al., are going short against everybody that's going long right now, and that's what's keeping the price under wraps.
What's happening in physical versus paper gold and silver?
Well, if you look at the what's going into the various and sundry ETFs, mutual funds, etc., all over the world, which I keep track of on a daily basis, gold and silver are continuing to flow into all of these funds in large quantities on some days. The trend is up. The accumulation of physical metal, not only by the world's central banks, but by the smart money out there, has been ongoing for years now, regardless of what's going on with the dollar or the stock market. And that trend has accelerated by a great deal in the last 9 months.
How are the HUI and XAU indexes looking, and how is the October situation showing up for junior gold and silver stocks?
Well, of course, the XAU and the HUI follow what's going on in the precious metals almost tick for tick. So the gold price going up, of course, the shares are going to follow. The junior producers, of course, on most days, if the price is rising or falling, will outperform. I know that I have a lot of junior producers in my portfolio, mostly silver junior producers, and they vastly outperformed the HUI and the XAU all this year, and that they will continue to do that. But all precious metal stocks are basically tied to what gold and silver prices are doing. And I'll just add to that if you're looking at the exploration companies, and I have a couple in my portfolio, the exploration companies always tend to lag, and they're the last ones to really perform when the silver and gold prices take off higher. So their performance has been rather lackluster, but the shares themselves have been doing rather well for themselves this year. I know the HUI's up 37% so far this year. That was as of yesterday. So it's been a good year for the stocks, and the silver equities are up about 20-some%. So everything's doing well, and the silver stocks, of course, are underperforming because the silver price is underperforming because J.P. Morgan's sitting on it.
We'll have more with Ed Steer when This Week in Money continues.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. We're speaking with Ed Steer. Ed, what indicators are you currently watching for gold and silver?
I'll tell you what. It's very simple for me. I watch the charts every day, what gold and silver are doing. But the only thing that really matters is what's going on with the commitment of traders. What are the commercial traders doing versus the managed money traders? I have a chart that shows that the gold price follows what the managed money traders are doing almost 100%. So that is the only indicator I watch. If they're in the markets buying, there's no question about the prices going up. And when they're selling, the price is going down, and the relationship is 100%. So I look at the prices every day, but what I really look at is the Commitment of Traders report, which comes out on Friday. And from that, you can deduce whether things are positive for the market or negative for the market. Right now, the Commitment of Traders report is very bearish in gold and almost as bearish in silver. So it's not looking good going forward, but there's no guarantee that it's going to turn out with another major price smash to the down in either precious metal. But if you had to go by the COT report, that's what it's showing right now.
If the stock market has a major decline, do you expect higher interest in gold and silver?
Oh, I certainly expect that. It all depends what's going on at the time and what precipitates it. We could see gold and silver prices take off the same time that the stock market declines. But even if they don't and gold and silver get caught up in the general sell-off for a little while, there's no question about it that at some point during the if you want to call it a crash or a swoon in the stock markets, they will certainly outperform everything else.
What's new with GATA, the Gold Antitrust Action Committee?
Well, Bill and Chris are in New Orleans right now as I speak. They're speaking at the New Orleans Precious Metals Conference there, which starts today and runs through until Monday. And I know that Chris is speaking tonight, and I think Bill has a slot on Saturday. And so, GATA is still out there actively preaching the word that the precious metals prices are being managed. This has been going on for 20 years now. GATA's been at this sort of thing, and of course it's now 100% common knowledge that, GATA's been right, and of course silver analyst Ted Butler, who's been at this longer than anybody, about 35 years, everybody in his dog in the precious metals industry knows the prices are being managed, and all we're waiting to happen now is to wait for this thing to end so we can all make our fortunes and go home.
Mm-hmm. Now, why do you think, with so much evidence that gold and silver prices are being manipulated, very little has been done to do anything about it?
Well, there are several reasons. First of all, I think that the main reason, the miners themselves, they all know about it, of course, now, and they don't speak up much about it because, their mines are basically in countries that may not want this sort of publicity. And the banks, every mine owes the banks some money, and most of the banks that they deal with are bullion banks, Scotiabank, J.P. Morgan Chase, Citigroup, you name it. That's where all their funding comes from. And the second reason is there's just no resolve amongst the miners to do anything about it. It's really sad that they won't do anything about it. They have organizations like the Silver Institute and the World Gold Council that are in a perfect position to complain about this. But for whatever reason, which escapes everybody, they just sit there like lumps and let the mining industry and their shareholders burn in hell, which is not exactly making the average gold and silver investor very happy.
Mm-hmm. Ed, how can people find out more about your newsletter?
Well, they can just Google my name, which Ed Steer, S-T-E-E-R. My website will pop up, and they can go to the tab there that gives them a free sample column, and they can read that. And that's the sort of content that they get every day, 5 days a week, 52 weeks a year. So, and the cost is US $100 for about 262 issues a year.
Ed, thank you so much for being on This Week in Money.
And thanks for having me on, Jim.
My guest has been Ed Steer, founder of EdSteerGoldandSilver.com. He's also a director of GATA, the Gold Antitrust Action Committee. He was speaking to us from Merritt, British Columbia. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Josef Schachter, and Ed Steer. And thank you for listening. If you have any questions for our guests or for the show, you can send them to info@howstreet.com. I'm Jim Goddard. Now stand by for a company showcase update from American Manganese CEO and President Larry Reaugh. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen. Welcome to Company Showcase, an advertising feature on HoweStreet.com.
I'm Jim Goddard. I'm speaking with Larry Reaugh, CEO and President of American Manganese. Welcome back to the show, Larry.
Thanks, Jim.
Larry, a lot of people are wondering, with electronic cars becoming more popular, and they're expected to be the big wave of the future, what are they going to do with all of their batteries? Does your company have a good idea where those batteries could go?
Yes, we certainly do have a good idea. We've got a patented process, 2 patents on it, a third one that will be filed. And Just speaking of that, the electric vehicle market has been kind of in a bit of a decline, mostly because of the tariffs, and but that is expected to pick up, and which means that the EV battery manufacturing will pick up along with it. There's hundreds of companies out there that manufacture batteries, and there's a handful of companies out there that recycle using mostly methods that will not be approved in the future. And so what does that mean for us? That means that a lot more attention will be brought onto the company, and we can always use that. We're fairly well known out there. We've been picked up by a lot of peer magazines on recycling, and they have, posted our press releases or posted a report on us. And again, that shows you that the company does have a high profile. You may not see it in the market, but you have to remember that the New York Exchange is in bullish territory. The biggest bull in its history is ongoing, and it looks like the biggest bear in its history is ongoing on the Toronto Venture Exchange. So, that said and done, I'd just like to talk about a couple of questions that I have fairly often. And one is, what does Kemetco own in the patents, and why would they give them to us, and that sort of a thing. Well, I'll just go back to my mining days. When we make a discovery of ore, we hire an independent firm to eventually come up with a 43-101 resource study. And then when that's completed, we hire independent labs. These are all arm's length, to work on our metallurgy and, to make sure that we can get the best recoveries. And then eventually we hire a outside source to do our environmental permitting. We try to keep all those things arm's length, and certainly the feasibility studies are all done by independent sources. That's so that the banks can look at them and say, hey, these guys got something, let's talk to them. And it's no different with technology. We are a mining company, and we have ideas, and we exploit those ideas by hiring contractors like Kemetco. Kemetco does not own anything in the patents. They don't own anything in the intellectual properties at all. They are not even allowed to own shares. So that tells you that they're independent. They're arm's length. They're not so much a partner as they are a contractor, and they do excellent work, and that's why we've been working with them for going on 10 years. So let's get rid of that myth that that Kemetco owns part of the project, because that's a question I get asked on many occasions. Now, the other thing is that we're talking about the interest in recycling. Well, another company came out of Singapore and said they're putting 2 recycling plants in, one in Singapore, one in France, and it was going to cost them $25 million. Well, that sounds awfully close to what our 3-ton-a-day plant is going to cost. And so, I have to say you have to read through those things carefully. Do they have a recycling process? I really can't find that anywhere. And but this is the sort of things that are happening, but we don't mind that. That's fine. The more people shining a light on recycling, the better off it is for everybody in the recycling arena. And the other thing is that when we look at patents, and I've been very vocal on the fact that we have patents, and that's what people should be looking at. Because when it comes to actual battery production, I see, in a year I'll see anywhere from 300 to 500 patent applications to improve the batteries, or new batteries, or the cathodes, or the anodes, or the all kinds of different things to do with batteries, and those patents are filed from all over the world. And when I look at the recycling, I could count them on one hand, and 2 are ours, patent applications. And so, the field is pretty narrow there. It's somebody's talking about a $6 billion recycling market in 2030. I think it could be close to $1 billion now in 2020, and that's a big arena to play in. There's room for a lot of different companies to be recycling, just like there's room for a lot of different battery manufacturers. So, again, it really depends on your patents at the end of the day, that you strive to get the best out of what you're doing. And if you can, you patent that, and it's not patented by somebody rubber stamping it. Somebody goes through it piece by piece by piece. And if you have any conflictions with other patent applications, there's a good chance that your patent will not be approved. So that's the patent arena, and it always excites me to see the amount of patents that are applied for. And the reality is that there's hardly any applied for in our area. So that should make everybody comfortable. I mean, we're in a kind of a bear market on the venture exchange, but that will pass. And I don't believe that the New York exchange is close to collapsing yet. I think that it's going to continue for a while yet. And I think you can congratulate President Trump on that. He's the guy that's made the market for the last few years, and he's the guy that's driving ahead to make better markets. And the tariff war, well, I think that'll be over soon. So, that'll take a lot of uncertainty out, and I don't think that that lithium is in oversupply or is close to being eating up the stockpiles that have been built in China. China's famous for building up stockpiles, and then the prices collapse, and that will change too. But I think it will be a little further, maybe late next year, maybe. But that's kind of the way I see it, Jim.
Larry, for people new to American Manganese, what are you guys all about?
We're a critical metals company that developed a process for treating very low grades of manganese. And this is another big feather in our cap, because that is a crucial metal for the United States. And there's lots of material at Tillery Peak that can be exploited. And we have a methodology for doing that, and it's patented. And off of that patent, we moved into the recycling arena. Started really moving into it in 2016, and now coming up to 2020, we're probably 3.5 years later. We're 2 patents under our belt. We've done the 5 stages in a pilot plant, which should make everybody happy. And so we're looking at cobalt, lithium, nickel, manganese, aluminum, those types of cathode materials, and I think the company, if it keeps on track, will definitely have a great future.
Larry, where are you traded, and how can people get more information about American Manganese?
We're traded on the Toronto Venture Exchange under the symbol AMY. We're traded in the U.S. under the symbol AMYZF. We're traded in Frankfurt under the symbol 2AM. You can do your due diligence by going to our website at AmericanManganeseInc.com, and or you can phone me at 778-574-4444. Or email me at LREAUGH@AMYMN.com.
Larry, thanks a lot for the update.
You're welcome.
I've been speaking with Larry Reaugh, CEO and President of American Manganese. I'm Jim Goddard. Our conversation took place on November 1st.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated.